Hi everyone, I'm Sarah Strauss with The Place to Mortgage, and I wanted to come on today and have a little discussion about the difference between a fixed and a variable rate mortgage. This week in particular, we've had quite a few clients contacting us asking, well, should I go fixed or should I go variable, and what's the difference between the two? So I thought I'd come on and give a little bit of an explanation on that. So first of all, we've got a variable rate mortgage, and variable rates mortgages are a mortgage where you'll it'll be a 5-year variable rate. So a lot of people think, it's not fixed in, or it's not, you don't have still a contract, but you still have a 5-year variable rate mortgage. But what your rate is, it'll be a certain number, a prime less a certain percentage. So right now we've got variable rate mortgages that are around, prime less 1%, for example. And so what that would mean is our prime rate right now is 3.45, and so prime less 1%. Most people are getting a prime rate right now, or a variable rate right now of 2.45%. But what's important to know is if you are in a variable rate mortgage, you will, your rate and your payment will and can fluctuate during the term of your mortgage. So for example, as the Bank of Canada meets to change prime rate, you could find a change in your interest rate as well. So our Bank of Canada meets 8 times a year, and in those meetings, they will decide, hey, are we going to change prime rate today? And if they decide to, they could, increase it up, or they could increase it downwards, dependent on their feelings on the economy. And then accordingly, if they do, you will get a notice from your bank saying prime rate has changed, and we are now, changing your interest rate on your mortgage and the amount of your payment. The fixed rate, so if you decided to go into a fixed rate mortgage, your mortgage is then fixed. The rate is the same for the entire term of your mortgage. So you can take a 3-year term, you can take a 5-year term, we even have up to 10-year terms. And what that means is whatever the fixed rate is at that time, you are locked in, and it's not going to change no matter what for the entire term of that mortgage. So right now our fixed rates are, running around 3.34 or a little bit higher. And, anybody who's taking a fixed rate, they are locked in for that entire term. So that's kind of the quick Coles Notes version of the difference between a fixed and a variable rate interest. So now lots of people ask me, well, how do you determine, what makes the rates change, and how are they determined? So the variable rate, I've already kind of explained, is based on prime. So our variable rates are always changing based on the prime rate. So the bank will determine, whatever banking institution you're dealing at, TD, Scotiabank, First National, Street Capital, whoever you deal with, they'll decide our rate is prime less 1% or prime less 0.75 or whatever it might be. And that is dictated by the Bank of Canada prime rate. Our fixed rates, on the other hand, are determined based on our bond rates. And so if you're a savvy person who's watching, bonds, you'll be able to tell if our fixed rates are going to start to increase based on where the bond rates are going. And lately we've seen bond rates increasing. Actually, right now our bond rates are about 2.25. And I know that any financial institution that's selling mortgages, to make good money or to make money at that, you need to be selling your mortgages, your fixed mortgages, at about 1.5 over the current bond rate. So to me, I know that right now, in order for an institution to be making some more money on a fixed rate mortgage, that mortgage should be being sold for about 3.75. And right now I know that we're not selling fixed rates, we're getting fixed rates at under that amount. And so what that means is that I know that the institutions right now aren't making very good money on fixed rate mortgages, and so we're going to see them go up. I think everybody's just being a bit stubborn right now, and trying to hold tight. But if our bond rates stay where they're at or continue to go up, it's not sustainable for fixed rates to stay as low as they are right now. So we are going to continue to see our fixed rates climb in the near future. So what we've seen now is that, lots of people, I would say historically, I've been doing this now for 10 years, and historically we've always seen, a lot of people are, fixed rate type people, and they think, that this is just what I need and what I prefer. They like the stability of a fixed rate, which is totally understandable. And throughout my career, I've always, presented both options and thought that, it's up to you to make that decision dependent on your risk level. With the exception of last year. So last year I found that, so I'm going to go back a little bit. Historically, from my time in the career and even before that, I found that, dependent on where you were, if you were to take a 5-year block of time, you are probably always better to be in a variable rate mortgage. But consumers at mass, I would say the majority of consumers choose a 5-year fixed rate. Now, whether that's because, they like the security, there could be a variety of reasons. Most people would choose a 5-year fixed rate. But historically, you're always been a bit better off in a variable rate, with the exception of last year. So last year was the first time in my career that I found that the fixed rates were, there wasn't a big difference. So for example, last year, we could get a variable rate and it might be, a little bit lower than a fixed rate, but that difference in the rate didn't justify taking no security of not knowing what was going to be locked in for the next 5 years. Now this year, and where we're at right now, is I am having a great discussion with most of my clients that are coming into new mortgages right now, because it's the first time in about 10 years where I really feel that you're better off to be in a variable rate mortgage if you're getting a new mortgage these days. So where we're finding our fixed rates are at, right now we're still around 3.5%, but we're selling variable rate mortgages right now for prime minus a 1% or even more than that. Yesterday I sent out a commitment to a client, and their variable rate mortgage starting out right now is at 2.16%. Now that spread between 2.16 and what their fixed rate would have been at about 3.5, that's a huge difference right there in a rate. And typically the bank, I told you the Bank of Canada meets 8 times a year, and they would possibly increase maybe 0.25% at a time. And so that the Bank of Canada has to increase the fixed rate, or the variable rate, prime rate, several times, about 4 to 5 times to make it even to where you would have started with a fixed rate. And, even another 4 to 5 times after that to even catch up on the savings you got in the first 5 years. So right now I'm having a conversation with a lot of people about, maybe now is a time to go into a variable rate mortgage. I've also had lots of clients reach out, and I wanted to chat with you about this today as well. And, lots of clients are coming to me because I think the media, the news has a great way of alarming us or putting fear in our heads. And, everybody's like, well, rates are going up, and maybe I should renew my mortgage early. And please don't let any of that scare you. Rates are going to be where they're going to be, and whether it's time for you to be a homeowner or not, that should be the last thing that determines you getting into home ownership. But one thing to know about is if you are in a fixed rate or a variable rate right now, we are doing quite a few analyses every day and determining, so if you have a mortgage coming up in the next 2 years, I'd say, depending on where your rate is at, it might be worth you exiting that contract early. We can determine what the penalty might be. And right now we're finding that penalties are actually quite low. And I'm finding that a lot of clients are taking advantage of moving to a new lender and securing a new either fixed rate if they like the security, or going to a variable rate. And we're finding that the interest that they're going to be saving over the next 2 years or possibly 5 years is far outweighs what their penalty is. And so we can put that penalty into the new mortgage and end up showing you how we can turn it around and end up saving you, a few $1,000s in the next couple of years. So if that's something that you think you might be interested in, reach out. I'll be the first one to tell you if it's not in your best interest. But all we would need is some information on your current mortgage, and then we can just do a quick analysis up for you. I've got a super nerdy spreadsheet. I enter all the numbers in, and it pops it out and lets me know if it's something that would benefit you or not. So I hope you found this beneficial. If you have any questions or comments or anything that you want to learn more about fixed or variable interest rates, give myself a call anytime. The office number here is 403-865-8123, and my email address is sarah@theplacetomortgage.com. And I'm going to try to do more of these Facebook Lives. They're kind of crazy, and Instagram Lives. And next week I'm going to come on and talk to you about interest rates and rock bottom rates, and how I'll never be that mortgage broker that gives you the best rate out there and the reasons why. So everybody have a great day and happy weekend, and we'll chat with you next week.